After years of economic fireworks, the US and China just hit pause on their trade war with a 90-day tariff truce.
We have reached an agreement on a 90-day pause.
But what does this temporary ceasefire mean for the global industries? And can India come out as an unexpected winner? Hi everyone, I'm Avni, and welcome to The Next Big Thing, the channel where we connect world events, market trends, and geopolitics to spot high impact investment opportunities. In a surprise move, the US and China have agreed to a 90-day reduction in tariffs in their joint statement on May 12, 2025. The US is cutting duties from 135% to 30%, and the China is cutting duties from 125% to 10%. That means Chinese goods are heading to the US and fast. But for India, that could spell trouble. Indian products could get pushed aside as Chinese supply chains reboot, at least temporarily. And with US's tariff suspension on countries other than China, including India, ending on July 9th, the pressure is on. India has a tiny window of opportunity to finalize a favorable trade deal with the US or risk losing this temporary advantage that we have. India still has a few aces up their sleeve. Thanks to the China Plus One strategy, a lot of global manufacturers are still looking to diversify their supply chains beyond China, and India can benefit from it, especially in the smartphones, tablets, and laptop segment, all of which currently enter US duty free at least till July 9th. Plus, India's PLI schemes, a huge labor pool, and rising scale in electronics, toys, and textiles is fueling India's manufacturing momentum. But here's the problem, this edge is only guaranteed until July 9th, and then it's anybody's business. The biggest problems for India are the tariff gap between China and India is shrinking. Global firms are also betting on Mexico and Vietnam. India still relies heavily on Chinese intermediate goods, which is a big risk for local production. India still faces big infrastructure gaps, especially in terms of logistics and industrial clustering. And the worst case, India could become a transshipment hub for Chinese goods, undermining trust with the US and possibly damaging future trade deals. Meanwhile, sectors like textile and steel are worried about a wave of cheap Chinese goods being dumped in India after being rejected by the US. The result? Slowdown and a decrease in factory output right when India needs to scale up. This isn't just economics, it's geopolitics. The US China rivalry has made India a key player in the region. Washington wants a strategic ally while India wants autonomy and also access. Both countries are trying to counterbalance China's rise in Asia, but both also worry about each other's loyalty. India fears a G2 moment where both US and China make peace and leave India out, while the US wonders if India's non alignment means it's not a reliable partner in the long term. This mutual suspicion could complicate cooperation just when timing matters the most. So, what can India do to seize the moment? Finalize a bilateral trade deal with US before July 9, double down on Make in India and PLI schemes to boost local manufacturing, prevent transshipment of Chinese goods with strict import monitoring, scale up exports in pharma, garments, agri-products, gems and jewelry, all of which are currently India's strengths. And finally, keep deepening India-US consultations on China without expecting perfect results. Let's now talk about the big question. Should you be investing in any of this? Are these trends worth capitalizing on? The short answer, it depends on your risk appetite and time horizon. Because while this 90-day tariff truce is temporary, the underlying trend of supply chain diversification is structural and long-term. Here is what investors and analysts are watching closely. Number one, as companies move from China dominated to China plus one model, India is increasingly in spotlight. This could open long-term opportunities in industries like electronics, pharmaceuticals, defense production, logistics, and infrastructure, all of which benefit from policy support and global rebalancing. And number two, global realignment often leads to capital reallocation. If India continues to strengthen its ties with the US and trade reliability, it could attract more foreign direct investment and portfolio flows, particularly in sectors aligned with global supply chains. But caution is warranted in some areas. Not every sector is poised to win right now. Textiles and steel may see an influx of cheap Chinese goods during this 90-day tariff window, putting pressure on domestic prices and margins. Electronics assemblers who have a heavy dependency on Chinese components might see a disruption in supply or cost spikes, and low margin exporters in commodity based sectors might feel struggle to stay competitive. It is wise to stay cautious in these sectors at least until July when tariff scenario becomes clearer. Apart from these, there are a few more risk factors to watch. Policy delays being one. Policy reforms in India often take more time than expected, with delays in implementation or inconsistent execution across states. This uncertainty can make businesses hesitate, and this is a big risk, especially at a time when speed is critical for the global supply chain shifts. Infrastructure gap is another big risk. India's infrastructure, while improving, still lacks in a lot of areas like logistics, power reliability, or industrial clustering. These gaps can slow down production and raise costs, making investors cautious despite long term potential. There is also the risk of short term volatility because of geopolitical flare ups or sudden shifts in US China relations. Bottom line, while no one can predict markets, long term macro signals are strong. But trends don't automatically translate into profits. It is essential to track policy clarity, execution on ground, and global sentiment, not just headlines. Thanks for watching. If you found this breakdown valuable, make sure to like, subscribe, and hit the bell so you don't miss future deep dives into global trends and investment opportunities. See you in the next one.